Hi, everyone. Good afternoon. And first, I want to thank the BioCat team for inviting me here to share my perspectives on the market at this exciting time. It is impossible to overstate the shift in market sentiment for biotech that has transpired since everyone was probably sitting in this room a year ago. After what we would call a brutal and Darwinian process that saw the number of US biotechs shrink by nearly 40% since the pandemic, 2025 was the year the market decisively broke out of a 3-year swoon. If you look at this chart, the XBI, which is a closely followed biotech index in the US, rose 35% last year. The broader US biotech market that we track rose 55%. Globally, biotech valuations by some measures surged as much as 95%. That was heavily impacted by performances in China and Korea. And in Europe, we saw the market up 11%. But that number hides the highly successful performances of winners like Asabys and Nanobiotics, which were rewarded for stellar data. So in short, we've seen the total value of public R&D stage therapeutics companies climb 129% since the market bottomed out in April of 2025. That is a completely different story than the one we've been telling for the last several years. On this chart, you see, importantly, for the last 6 months of 2025, biotech actually outperformed the technology sector. That's sort of unheard of. By some measures, biotech was up 44% in those last 6 months versus only 10 to 15% in the technology sector and the broader markets. And right now, in the first sort of 6 weeks of 2026, we're seeing software sell off with concerns about AI disruption, while biotech is actually holding up fairly well. We believe that this reflects the market's reawakening to the value of biotech innovation. Now, as we sit here in February 2026, the tape, as we call it, has turned a bit flat. The XBI has been oscillating around 125 to 130 for the last several weeks. And while some fear that maybe this is a market top, I guess I'm here to argue that we see this as a plateau, not a ceiling. We think we are standing at the beginning of a structurally stronger era, underpinned by normalized funding, a powerful M&A cycle, and a fundamental shift in how we price innovation in giant markets. We see these flat markets as maybe catching our breath. We believe that we can get to 150 on the XBI by year end. But before we get into why we believe that and what we think the key drivers of the growth will be, I wanted to run through a quick review of what happened in the markets in 25 and so far in 26 to help position us to look ahead. So critically, this has been a data-driven recovery. The 2025 rally was not a rising tide lifting all boats. It was a flight to data, and quality data specifically. The market has become a show-me market. So we see that on this slide in the advance of the phase 3 evaluations, which are over on the right, relative to the other categories. You will note that all clinical data companies today are valued materially above the preclinical companies on the left. If you looked back to the 2021 biotech heyday, which are the blue bars, you can see that the preclinical and the phase 1 companies actually traded in a similar range. But investors today are hyper-focused on de-risked assets. Phase 3 companies with strong data are trading at vast premia compared to the early-stage peers. And not unrelatedly, in 2025, nearly every major acquisition by Big Pharma targeted companies that had already hit their data inflection point. So one of the reasons a company can attract investor interest, obviously, is the belief that they may be a target for future M&A. So that's why you're seeing those valuations go to the right, move up as we de-risk things clinically. Moreover, value is aggregating in companies that we would characterize as having a very good data set. That is, it's a sort of a somewhat subjective distinction, but what we mean by that is companies that have demonstrated strong clinical signals that their therapies could meaningfully outperform the current standard of care. So you can see that this is not simply a data-driven market, where any old phase 2 company might expect to be valued more than a phase 1 company. Rather, it's a very sophisticated market, and it understands and it sorts companies by the perception of the strength of the data. And data strength will obviously lead not only to potential approval and to commercial success of a drug, but it also increases interest for potential acquirers or strategic partners. And as we've mentioned, that's important to driving investor interest. As you can see on this slide, capital formation has reaccelerated. So financing in 2025 was broadly similar levels to 2024, but, and with the caveat that it's a bit early in the year to extrapolate, you can see here, 2026, we expect this to be close to a record year for capital raising in the biopharma sector. Now, 2025 was the slowest market for biotech IPOs since 2012, but we have seen over $1.5 billion in biotech IPOs so far this year. We saw Veradermic's price an upsized IPO and surge 122% on day one. Icon Therapeutics raised $381 million in an upsized offering at the top of the range. It was the largest biotech IPO since 24. And Actis Oncology opened the year with a $318 million raise and traded up 24% on its debut. That name's only a few. We expect over 30 companies to go public in the US this year. So the window isn't just open, it's being driven open by high-quality science. The IPO market today, it's not a story stock retail frenzy from the pandemic, but it is open for the high-quality stories that are coming through. And I'd mention another company here as we talk about IPOs that have happened so far, which is Agamab, a European company that went straight to the NASDAQ. A European company going straight to the NASDAQ market hasn't happened in a long time. Normally, the Europeans debut later in the cycle if they go to the US at all. But this is a testament, I think, to the strength of the science coming out of Europe. And in our view, it also reflects an understanding of investors today that you need to engage with European stories after the success last year of the likes of Abivax and Maris and others. Another point to make is that the IPO step-ups have remained pretty modest at only 1.1 times. That reflects a disciplined, fundamental approach to valuation and allocate valuation in the investor community. Allocations have been skewed to mutual funds, healthcare-dedicated investors, and existing investors. In comparison to the IPOs, equity follow-on volumes were high in 25. It was the third highest year ever, with the last quarter of 25 particularly strong. We saw serious investor demand for high-quality issuers. Importantly, both IPOs and follow-ons performed well. In 2025, IPOs and follow-ons like Maze Therapeutics and Sionna more than doubled after the April 25 bottom. That was versus returns of about 40% over that time period in the broader indices. And this year, we're seeing one-day post-offering performances of IPOs up 15%. This is critical. We need to attract capital, and we need offerings to afford investors better returns than what they could achieve in alternative places to put their money. So the window needs to be more than just open. It needs to be lucrative for the right stories, and we believe we're seeing that. We also, in general, need the public markets to be another source of an exit for biotech investors and not simply for having them rely on the M&A market. When the M&A market and the public markets are functioning together, IPOs, secondaries, M&As, people making money from different ways of monetizing their investments, venture financing strings can loosen and more money flows into the early stage companies in the sector. And we believe that's what we're seeing here. So venture volumes were flattish in 2025, though we did see average deal sizes hitting all-time high, so more money going to fewer companies. But 2026 is shaping up to be a very good year for volume. We believe this reflects that broader normalization in the markets. We saw $6 billion in deals hit the market in January, as VCs are anticipating a stronger IPO market to come. The total deal pace is nearing the record levels set in 2021. So while it's early to be extrapolating, and 2021 was quite a big year, we think this is going to be a big year for VCs and big year for attracting capital to early stage biotech. The other point to make is that public investors are looking towards getting into crossover rounds, late stage rounds leading up to IPOs. So far it's been modest, but the more that we talk to our investors, it was a persistent topic in recent conversations with them, that they're looking to get into the private markets, and we expect that with a good IPO market, that should continue to drive growth in the private rounds. And now to M&A. So 2025 was the third busiest year in history, with $223 billion in total volume. We saw 35 deals averaging over $1 billion or more, and M&A was incredibly active, in particular in Q4 25. Incredibly, despite the overall value of that market, we did not see any mega deals, nothing north of around $15 billion. So this was a year of many and consistent singles and doubles, to use an American baseball expression. Among the buyers, Big Pharma was active across the board, with Novartis and Merck leading the charge. Novartis alone has closed 10 deals since 2024. So the pace of M&A based on January numbers, though, is well below where we were last year. This is sort of an extrapolated number for 2026. Our own interpretation, though, is that this isn't going to last, that the market is going through maybe a bit of a repricing period. We talked about how in the last quarter of 2025, the biotech valuations went up, and I'd say people are pausing and digesting the new prices required. But private conversations with buyers indicate the willingness remains to engage. So while things feel tepid so far in the M&A market so far this year, we believe this lull is temporary. And in particular, there are structural reasons why this lull is temporary. If you look here, Big Pharma is facing a massive revenue hole from upcoming patent expiries. Over 40% of top pharma sales are exposed. Even with internal pipelines, we estimate there are $90 billion of revenue that can only be filled externally. And only 14% of the industry's total revenue need was met by 2025's M&A spend, which suggests that M&A volume must rise in 26 and 27 to meet the looming expirations. And the pharmas have the money to do this. So pharma balance sheets have never been better positioned to bridge the gap. As of January 26, we estimate comfortable M&A firepower exceeding $500 billion in the large pharmas, with a stretch capacity, which we define as taking debt to 5 times EBITDA, reaching a staggering $1.2 trillion. So M&A is going to continue to be active in the biopharma market. Now, we wanted to talk about a few trends that we see driving the market from here. We've touched on the need for M&A, but we've identified and anticipate a number of other drivers supporting our industry, and I want to take a look at these one by one. So to us, one of the most significant trends for 2026 and beyond is what we call the medium price in giant markets, or MGM. For years, our industry was bifurcated between high-priced specialty drugs for narrow populations and low-priced generics for the masses. But the obesity market has completely rewritten this playbook. We saw President Trump's administration lock in a deal for Mounjaro and Wegovy. And at first glance, that might have looked like a concession for Eli Lilly and Novo Nordisk. They agreed to something like $350 a month for these drugs, or about $4,000 a year. But let's do the math. By agreeing to that median price, Lilly and Novo gained access to 51 million Medicare and Medicaid beneficiaries. We estimate that the total addressable market for obesity now exceeds $200 billion. And relatedly, and for the first time ever, a pharma company, Eli Lilly, has approached the $1 trillion valuation mark in the public markets. So this model of creating record-breaking products by charging median prices for giant markets, we believe, is here to stay. And we think this is going to go into multiple other therapeutic areas. So COPD, Alzheimer's, migraine, many other markets. And this will drive valuations in ways people may not yet have appreciated. Okay, so you can't speak at a biotech conference, and maybe not at any conference these days, without talking about China and AI. So I'm going to wrap up with a few perspectives on both. With respect to China, I'm going to offer a statistic. In 2025, nearly half of all big pharma licensing deals were with Chinese counterparties. Take this in the context of this. Only 5 years ago, the sector was almost derided as a laggard for failure to produce an effective COVID vaccine. But today, there is a clear commitment of the Chinese government to support their industry. Our colleagues learned on a trip to China in October of 25 that the government is dropping many billions of dollars a year to directly support the Chinese biotech VC ecosystem. This is fueling the rapid improvement in pipeline quality in China, as evidenced by the number of licensing deals that we're seeing. And the government is not going to relent. I think to adapt the point that by the previous speaker made, science is not just a national strategy at the AI level. Science is a national strategy. So while we don't believe China biotech is an existential threat to Western biotech, we do think there are longer-term considerations that it's raising for our industry. And at the heart of it is this: China's speed and efficiency, and the fact that they're benefiting from a vast, highly skilled workforce. In some cases, it's reported that China is doing discovery work 2 to 3 times faster, and clinical development work 2 to 5 times faster than their US and European counterparts. Critically, this is also done at lower costs. Now, of course, China is an opportunity for Western biotech insofar as Chinese outsourcing partners for chemistry work, for production, these are available to Western biotechs just as readily as they're available to Chinese biotechs. And last year, we saw Biotech, a Belgian cell therapy company, exit to AstraZeneca for up to $1 billion, including $425 million paid up front. Biotech entered the clinic on the back of an investigator-initiated trial in China. To me, this is a demonstration of successfully leveraging the China ecosystem to the benefit of a Western biotech. So we see the main lesson from China to be that it is possible to be more efficient in this industry than maybe people have previously thought. A recent article from Brian Finrow in Stat argued that the West needs to counter China with its own type of intensity. This would involve, for example, making more data available to enhance the industry's collective memory and for lowering the costs and barriers to running clinical trials. These are ideas that we believe we all need to engage with. And finally, as we look ahead, the impact of AI will shift. It's not just about drug design. It's about agentic AI revolutionizing care delivery. Agentic AI, particularly recent breakthroughs from Anthropic, will allow AI bots to manage medical records, book appointments, manage follow-ups, bypass some of the sclerotic bottlenecks of the traditional medical system. And this could fundamentally expand the bandwidth of our industry. And most critically, to biopharma development, AI is going to materially drive improvements in clinical trials. It's important what AI can give to us in terms of discovery. But when we think about development and the dollars that are spent on clinical development, it is critical to be integrating AI into our clinical trials, finding the responders up front so that trials are cheaper and shorter. This should, in theory, drive the probability of success up for drugs in the clinic. Overall, we expect clinical development to become 30 to 50% faster as AI automates patient eligibility and signal detection. And then finally, we just will touch on scaling of innovation. The cost of achieving innovation in biotech is dropping. R&D productivity is emerging. The key driver here is the improvement in our ability to interrogate underlying biological causes of diseases. We saw the last speaker, he said that AI is a new instrument of science, and that's exactly right. As Hal Barron of Altos Labs noted, we are moving from experimental biology to theoretical biology. Just as physics advanced from a theoretical framework that shrunk the search space for experimentalists, massive at-scale data collection will allow us to make predictions about cell biology that will transform R&D productivity forever. We are getting better at genetics, we're getting better at omics, and better at designing drugs that program behavior such as ADCs and T-cell engagers. Today, based on internal STIFEL classifications of clinical differentiation, 29% of all public biotechs possess a very good data set. That's up from just 9% in 2022. The substrate for innovation has never been richer. And so to conclude, we must acknowledge that the geopolitical and macro environment, it remains uncertain. Political pricing pressure, FDA unpredictability, this is all real. But the fundamentals are sound. Europe and Catalonia benefit from immense scientific productivity. The giant markets are opening, and the M&A market is structurally supported. The history of public biotech market performance shows that once a breakout begins, and we've seen that that breakout has begun, it tends to have a multi-year positive run. So overall, our outlook remains constructive. We believe the XBI can cross 150, and for investors, for companies, and most importantly for patients, the outlook for biotech has rarely looked more promising. Thank you.
Thank you, Kelly. It's been a very inspiring talk, and it gives us an optimistic closure to what we've listening in the morning. It's for us as investors, we've been waiting for this kind of like turn of the curve for the last years. It's like, okay, second half, it's gonna, the markets are gonna open, M&As are gonna pick up, and it seems it's finally happening, right? This last, from what you say, I mean, M&A is always before than the actual opening of IPOs, but we were really seeing a change.
Both. I think we do. We do feel like it's a change. I mean, last year we even saw a biotech company go public here in Europe alone, right, with Bioversus, you feel the markets opening. And as I was saying, we need the markets to open to give people more than just the opportunity to exit through M&A, to get the venture money flowing a little bit. For the last several years, venture money has had to keep their dry powder, is the expression that we use. They've had to maybe guard their money because the companies that they were invested in might need future backing. It might need money. There was a tendency to hoard, right? But when you see the wheels start working again, and that can't be just M&A, but when it gives you the opportunity to IPO, when you think your company may find investment from multiple different angles, it gives people the comfort to invest. And we think that's now working again. Yeah.
You said it. We really need the wheel rolling. I mean, all of us who are in investment, and we've seen it during the last years, as you say, our funds were mainly dedicated to keeping our companies alive through convertible loans and trying to build the right data set to attract investors, to attract pharma. Although sometimes, you had the feeling that pharma were getting more and more conservative and trying to ask for more data, right? And it's been tough.
That's been tough. The request for more data is, we hear this from everybody, every single client that we talk to, every biotech we talk to, the desire for more data is real. And the willingness to pay for a de-risked asset by pharma has become massive, right? So they have the funds to do it. They can wait.
Exactly, and they need it.
They can wait. They need it, but they don't need to buy early. They're happy to have you go ahead and continue, that risk. And we've seen, I don't think that attitude has changed much, but I think a lot of the companies have managed to mature to a point where they are attracting these exits, and that's greasing, those wheels that we've talked about. Yeah. But how do you see that? I mean, you've been through multiple cycles. Do you feel that things are different now? In terms of company quality, in terms of capital availability?
Well, when I started back in 2016, 17, there was actually a lot of optimism in the sector, and it was easier to fundraise.
Yeah.
It started getting tougher, obviously, and due to this, what you're mentioning, right, the wheel has sort of stopped. So if there are no acquisitions, there are no exits. There's no liquidity to return to our investors. They're rather, depending also on interest rates, etc. We can touch on that later, but during the last years, it was more attractive to put the money elsewhere, right? So it's been tough, but we do see signs of change too. We do see this optimism, and not to mention the quality of science and the data that we're seeing, right? This is an example of what we've seen today, not only in Catalonia, but also in the rest of Spain, although obviously Asabys invests internationally, right? But the science is amazing. You still find really good projects with, so the more money we had, more we could invest, right?
Yeah,
so there's a lot of good options out there. And this sector is, if the wheel starts running again, we're boom from success.
Yeah, and the interest rate point that you made, that I won't dwell on it for long, though, it's an interesting one because people often say, well, what do I care about interest rates, right, in biotech? But what we need is when the interest rates are so high, so people will often want to put their money somewhere safer because the returns are so high. And we've been seeing them come down, and we're hoping that they'll continue to come down, though it's hard to, the outlook these days is a bit cloudy. But as that continues to come down, higher risk capital, higher reward places like biotech, I think is definitely gaining more interest. Yeah.
You've talked about, obviously, this trend in the last quarter around the markets going up, etc. But when you go down to the actual deals, there's a lot of mega rounds and early stage still not taking off. What do you think needs to happen for, a lot of us are investing in early stage companies. Most of our companies are early stage. Ourselves, we're pushing or we're trying to raise a tech transfer fund or a really early fund, such as other colleagues in the room. When do you think this is going to take off?
I think if these wheels continue to roll, right, things will go into earlier stage capital. I mean, there's such good science coming out of Catalonia, coming out of Europe. I think that attracts people in general. But what's interesting, actually, to the mega round point is the mega rounds aren't all going to late stage companies, especially in the US, you are seeing mega rounds funding startups, right? And I think that's something we could learn from here in Europe. I think it may be a big ask, but I do believe that if people want to be a bit more ambitious, right, about what you are setting your companies up to do from the beginning, right, and the goal being to have optionality as you move into data.
This debate, yeah.
Right, and
we have it all the time with other investors, and not all the investors see it this way. We are also in favor of larger rounds to give this optionality to pivot if anything happens. And as you know, excuse my language, shit happens, right? With this kind of company. So it's always good to have the powder to pivot and go elsewhere. But people are concerned about valuations. Sometimes entrepreneurs don't want to get diluted. But, you know, I think this, and when you talk to US investors or even tech investors, when you're in health tech, that you have investors of both natures, they have a different mentality, right?
I would say that the obsession with dilution is not as high in the US ecosystem.
Of course not.
And I think that it's important that people maybe get their heads around that you are better off being diluted and having part of a giant company than coming back with the begging bowl every 5 minutes. The one thing we all know in biotech is you will need more money.
Yeah.
That's the only thing that we can all be sure of, and everything else, you know, we're sort of in the hands of science a little bit, where there's, you know, there's going to be failure, there's going to be other things, but you will need more money. So I'm a believer, you know, in raising these bigger rounds to the extent that we can, so that people have that optionality either to pivot or even on the back of good data to be in a position when you want to either exit or IPO, when you are empowered, rather than in the position where you are saying, well, I'm out of money. Unless you do this deal, right? Even when you have good data, that's not a great negotiating position to be in. So we like to, I'm in favor of the larger round, though it requires, I think, more capital here in Europe as well, right? We need to raise bigger funds. We need to be funding our sector.
Let's see next year at the BioRegion report if we can see some of these big rounds up here that's happening. I really hope so, and I hope
so as well.
We can contribute to that too.
Yeah.
So that'd be great. Actually, the two examples you mentioned have to do with our community, because you mentioned Asabys, which was invested by our colleagues from In Vivo, and also Agomab, that was a company, first of all, in our portfolio, but most importantly, based on assets that were from Spanish science, from Galicia, but with CEOs from here and also investors from Spain. So this can happen here, right?
It can happen, and these are really important exits, and it's very good science that's getting funded here, which is great to see. But I mean, how much, when you think about funding these companies, I mean, how much are you planning for an M&A trade sale versus growing them? How do you think about that in your investment committee?
Well, we always have M&As down the road, or IPOs, particularly for therapeutic companies, right? That's the kind of exit we normally look for. We also invest in health tech, as I mentioned, right? Diagnostics, devices, and some digital companies, such as Kita, for instance, here. These are companies that have in their plans to grow, obviously, and to grow and to go to US and have sales there. So they are completely different business models. So I would say it depends on which subsector we are investing in. But for therapeutics, I mean, you really want to, you know, build the value, get to the right value inflection point where sometimes it happens earlier. And we've seen in the past portfolio companies that got a term sheet to get acquired really early on, but then due to the market behavior of the potential acquirer, things change from one week to the other. So you've been exposed to that during these last years. It's been tough.
The last 2 years have been tough.
Yeah, and also for the CEOs. I don't know how many CEOs are in the room, and I really would like to acknowledge the CEOs, the task that they do, right? It's really tough because they need to deal with us investors in the board. They need to deal with the everyday work here, which sometimes, you know, they're not well enough funded. So there's also access to a lot of non-dilutive funding in Europe, which that is good. It might not really encompass with the timings of the companies sometimes, but it's got better, and that's certainly been very helpful. The EIC and other programs from Europe, that has been very helpful. But from your perspective, you've gone through our report. I know you're not knowledgeable on the Catalonia ecosystem yet, but we've been proud of what we've achieved during these 20 years, but we need to put this into context, right? We're a small country with some good assets, certainly good assets, and with the goodwill and optimism in the community, which is not a small thing, right? I mean, there's a lot of strong behavior working together, but where do you think we should put, our effort? I know it's everywhere, and it's a matter. But from what you've heard, what are our main assets, like clinical trials, for instance?
I look at it as a few assets. I mean, first of all, I think you've got phenomenal universities, right? Which means you've got highly skilled people, and you've got good research, right? And I think leveraging that research, bringing it out of academia into companies, I think that's an important thing to be focusing on doing. I think you've got great hospitals, which allows you to leverage things for clinical trials. I am a huge believer that sorting out clinical trial development is a huge point of AI, and it's a huge theme that we're going to be seeing over the next couple of years. We need to be more smart about where we're spending our development dollars. It's too often we have clients who, and I'm sure you've seen it in your own businesses, where you get a drug through phase 2, you've spent $50 million, on a phase 2 trial, and it turns out it only works in this kind of patients, but you didn't maybe pre-select those patients or somehow, and it looks like you failed at the top line, and yet it works in certain patient groups. It's a failure for patients, and it's a failure in terms of the use of capital. We should have recruited different people. We should have designed the trial differently, done something. So that
AI
this could
can
actually
certainly help there.
This is where I believe AI is going to really, make the difference. But I think, being part of that conversation in the clinical trials that you run here in Barcelona is important, and leveraging, your access to clinical trials through your good hospitals. I think, that's important. I'd love to see some, you've got really good venture investors here, and I'd love to see them equipped with more money to continue to fund these companies.
I'll bring you when I go fundraising.
But I think, ultimately, you want to see some success stories that don't go to an M&A exit. That ecosystem, that like a BioNTech was able to create, in Mainz, it's important. I mean, you don't want all of the assets to be sold. It's great if they're sold. It makes everybody money. It helps with those wheels that we were talking about. But building long-term, maybe a local champion in biotech would be a wonderful thing. Right?
Yeah, and I look at Robert here in the first row, because when I was also a CEO of BioCat, I got this from a lot of politicians, etc. It's like, why should we invest in BioCat? Because the companies go sell their assets or get acquired elsewhere, and what's it for the ecosystem, right?
Yes.
And there's a part of this that needs to happen, because you need to recycle the money, and you cannot go against the law or the rules of the game, right?
Yes,
you cannot be very local, otherwise you go nowhere, and you're not helping anyone. But we need to come together, and I don't know if it's at the level of Catalonia, Spain, or even Europe, right? To try to build the right markets or the right local champions, that we can grow the sector here. Otherwise, and going to all the products end up going to the U.S. market or to the IPO, right there.
Yeah, but one of the, reflecting on that, you've been on this project for sort of 25 years-ish, and you've made incredible advances at creating the hub here in Barcelona and in Catalonia that you have. And one thing that early exits or that recycling of capital will have done, besides attract more capital, is create a group of executives that are successful biotech executives, right? And those are the people that maybe are going to build those champions that we were talking about, maybe not being sold, staying independent in the future. It's unlikely that that's maybe going to be a first-time executive, but now if you've gone through that system and you're able to leverage the knowledge that you have and attract more capital because you've been a successful biotech.
Certainly, that's the density of the tissue. It's compared to in the beginning. There were a few pioneers, that all of them have white hair right now, trying to start companies, and now you see people who move from pharmas. In the past, it was unbelievable. You could not even think about people from pharma going to a biotech, because it was like this risky kind of second degree sort of sector, right?
Yes.
But now not only the tissue has become denser with people from our community, but as I was mentioning, we do attract a lot of talent from abroad. You know how our sector is, and now we're a player, right? We're in the map.
Right.
And so we do have CEOs from everywhere, or CSOs, or obviously investors. So that is so much different from what it was.
Yeah. Where do you see the next generation coming from? Do you think it's going to come out of academia? Do you think it's going to...
CEOs, you mean?
No, even the next generation of companies that get creative here.
Certainly from the research institutes
Yeah.
and also from academia and hospitals. I do firmly believe that, and what Pep was showing before, it's something that we all have very clear, you know, the gap between the quality and the amount of science that we've been able to build here and the access to funding or the success in transforming this into products and projects. So for sure, and since this gap was particularly high in Catalonia, and obviously even higher in Spain, so there's this will from the Spanish government and European government to put money to seed tech transfer funds or really early stage funds that otherwise would be very difficult to fundraise for the risk profile, to see whether we can help to really bridge that gap, right? And get more science and more technology coming out because, to be honest, and we're working very strongly directly with the researchers of all the different research institutions. This amazing science. We've seen, you know, our degree of achievements in ERCs or funding from Europe. We're #1 from the European Union money, or also in the level of highly cited papers, right?
Yep.
So, I mean, we do have the raw material there, right?
Yeah. Yeah. And how do you guys think about China as you're evaluating your investments?
Yeah, I think we should have it more present than we have, and we certainly should incorporate it in a lot of the equations, starting with potential assets to obviously BDs, and that we've already started working, to clinical trials, market. It's certainly going to make, I mean, when you see the numbers, and I took place in some debate in Europe organized by the Commission a few months ago, and they put that picture that you put regarding, you know, the clinical trials and all the new oncology trials come from China. It's like, oh, what should we do? You know what? We're still thinking about what should we do, what kind of regulation should we put to try to fill that gap. I mean, we're late. You know, things happen, and I mean, it's good news to have the Biotech Act. It's good news to have the mega fund in Europe. All these things that come to solve the regulatory maybe burden, but also to have more access to funding. But we need to move fast because it certainly should be incorporated in all our investment thesis and everything. China is always in the equation now.
Yeah, and I think it's interesting because here in Barcelona, maybe there's an opportunity to be a partner to some of the China companies that are trying to come this way, right? And to leverage what you have in terms of clinical trials and in terms of your ability to bring that edge. And I think people need to be thinking that way as well. There's a lot of fear, right? Right now, a lot of fear that, like, I'm developing something and it's going to turn out that there's something in phase 2 in China that I've never even heard of.
And pre-established kind of assessment or ideas of, you know, on IP or not good science. Look at the number of Nature publications. Look at the number of patents. I mean, this is old story. Now it's for real, right?
Totally wrong. I think it's not. We shouldn't be thinking that it's a Me Too playground in China
Not at
anymore.
all.
It's much more advanced than that.
Particularly now that we have the US, you know, the way we have it, right? And China, it's looking more towards Europe also for other things. I think it's an opportunity.
Yes.
But linking to this, I mean, AI needs to be incorporated in any pitch, China too, but the geopolitics too, because, I mean, it's been only, believe it or not, a year since Trump took office, right? And we've had such uncertainty regarding the tariffs, regarding talent, the cuts in NIH and the NSF. This is like a completely new playground.
Yes.
And it's here to stay?
I think it is here to stay. In the sense that uncertainty, I think, is here to stay for the foreseeable future. And I think what's been interesting is, so, you know, last year, you know, the famous Liberation Day when the tariffs came in and you saw the market, and in particular the biotech market, just collapse, right? So that was around April of 25, which was why so many of the statistics I was giving were coming after, you know, that. And I think people, after a while, took a view that this is just the norm. This is going to be the new normal, right? We have to operate our businesses in spite of any uncertainty, and we're just going to have to price in risk and move on from here. And I think that's where most people are. But it's hard to predict what's going to happen when the FDA is behaving erratically or, you know, unpredictably, right? And when things are changing. But the other point I guess I would add is that there are advances that have been made in terms of pricing, right, in the U.S. that Trump's introducing with Trump RX or that came in, with the IRA. And people sometimes think, okay, but when the new administration comes in, we'll go back to where we were. That will 100% not happen, right?
Yeah.
I mean, when you finally make gains on saving people money on pharmaceutical products in the U.S., no politician is going to come in and say, oh, but you know what I think we should do is go back to the higher prices, right? So I think we do all need to know that. I hope that the FDA becomes a bit more predictable than they've been. And
that's true. I mean,
all of those points I think are very, very important. But on pricing, I think we have to be realistic that changes that come through on pricing will matter. But that said, there was, when you think about MFN, and there's been a lot of talk lately about, so American companies, maybe they just won't launch here in Europe, right? Because they don't want these prices. Yeah. But what's interesting there, and going back to the China perspective, is the perspective that there are other people that will be happy to fill that market in Europe. I think the expectation had been maybe Europe will just have to rise their prices to get these new drugs from the U.S. But when you look at the competitive pipelines coming out of other jurisdictions, that might not be the way this goes.
The gravity might shift towards this, not only China, Korea, and India. We do have all of that, right?
Yeah, the law of unintended consequences, right? So I think everybody needs to be looking at all of that.
So we're in a kind of like moving scenario. We need to pivot and adapt.
Exactly, pivot and adapt.
Yeah, optionality out there.
Yeah.
Do you think that you were mentioning FDA, and we've certainly had some issues also because the unpredictability, that's the word, right? Do you think some indications or some area might get particularly affected? Like I'm thinking about women's health, I'm thinking about mental illnesses or vaccines, things that might go against the mantra of some of the leaders there?
Well, I think we've already seen that vaccines are complicated, right? And we've seen a U-turn, right, on Moderna's drug. And people I think vaccines are definitely complicated. I think we're going to see things maybe become unpredictable, even, I don't know, cell and gene therapy, places where people are, focused on where materials are derived or how they're derived. I think that might get some focus from the administration. CNS, it's an interesting point. I mean, I hadn't thought that through, actually, but I think there is an element of the MAHA that has ideas about how you treat illness that doesn't necessarily align with some of the developments there. So I think those spaces could all be.
Yeah, but that's going to certainly affect, investments because obviously all your reimbursement models, everything gets affected.
Yeah. I mean, how has that impacted how you prioritize?
No, not yet.
Not yet.
Not yet. And I hope it doesn't, because these women's health and CNS and mental health, these are spaces that are in need of innovation, right? So we need to push for those spaces.
I think that's right. I mean, I'll pick up on women's health just because it's something I've been very, following and quite passionate about. I do believe that we are attracting more investment for really good science in women's health than maybe we were even 5 years ago. And I think what's important that's been happening in women's health is people putting dollars to work for things that are, disease-modifying, genuinely good science, for endometriosis, for PCOS, for those kinds of conditions where we have a big unmet need. And traditionally, we've thought that big pharma kind of have moved away from, women's health. And I'm a believer that when we crack the science on some of those, disease-modifying places, rather than a Me Too. I don't think a lot of people get very excited about the next contraceptive or the next formulation for a menopause drug or whatever. I think people kind of view those as more or less sold. I'm not saying there isn't a market for that. I'm not saying there isn't need to improve. But if you want to draw, big pharma into women's health, I think cracking some of these big diseases like endometriosis, I believe that they would come back in with the right science there.
I do believe too, and we certainly have it in the top of priority too.
Yeah, it's a high priority.
Yeah. I think we're running out of time, and maybe we could leave with like one either prediction or wish for the next year from your side.
I mean, I predict that the market's going to continue to be very, very busy. And my wish is that, the European investment community puts, big pots of money behind good science.
Actually, that was my wish. That was my wish too, that Europe gets its act together finally, good science, and also less bureaucracy and more like action, right?
Action,
So, yeah.
Yeah, I mean, I think action is critical. I mean, you look at what we're competing against globally.
Yeah.
We got to move fast.
There's a lot at stake, not only in our sector, but the whole kind of, well-being. So.
Agree.
Okay, thank you very much.
So
it's been really nice
so
talking
much,
to you.
Nice to talk to you.
Thank you very much.
Oops.